At the end of each period, we need to make adjusting entries to get the accounts up to date for the financial statement. When we talk about adjusting entries, we are talking about revenues and expenses that affect more than one accounting period. Revenues that go along more than one accounting period. If your accounting period is for 3 months and you have a revenue that goes for 6 months, you have to do some adjustment at the end of the 3 months. The same applies for expenses. If you are paying for expenses for 1 year, but you are closing the books after 3 months, you have to do some adjustments for these expenses. The accrual basis in accounting, it dictates that revenue be recognized when earned and expenses be recognized when incurred. So whenever you receive money, you have to recognize it as earned, you receive the money, and whenever you have paid, you have to take it as paid. Every adjusting entry involves a change in either a revenue or expense and an asset or a liability. So revenues that we have collected before and they are not due now, they have to affect our liabilities, and expenses that we paid for in advance, they have to affect our assets. Let's see what we are talking about. In the type of adjusting entries, we will cover the converting of assets into cash. What are we talking about here? Let's dig a little bit inside. When adjusting entries is used to convert an asset to expenses, this means a transaction took place in a prior period, and this transaction involves the advance payment of an expense. You paid the rent in advance. So you paid rent for the whole year, but you did not use the rent yet for the whole year. You're still in the middle of the year. 3 common examples of adjusting entries to convert assets to expenses are the recognition of depreciation expense on plant assets. As you know, assets, they last for a long period of time, and we have to deduct depreciation from that asset for the period that we are using that asset to generate revenue. Another adjusting entry will be for using up of office supplies during a certain period of time. So also in office supplies, you buy office supplies probably for the coming 6 months, and you are closing the books after 3 months. You have to use the prepaid expenses for these office supplies. And at the same time, we're talking about the expiration of a prepaid insurance or a prepaid rent. As you know, you might pay the rent for 1 full year in advance, and for the insurance, you might pay the insurance for 1 year in advance. The adjusting entry is just made at the end of the current period, the period where we are closing the book, to recognize the conversion of the prepaid asset into an expense. The asset account is reduced and the expense account is increased. So what we have as a prepaid rent or prepaid insurance was entered before as an asset. So whenever I'm doing the adjusting entry, we have to reduce that prepaid insurance or prepaid rent expense and use instead as rent expense. So we will be debiting the rent expense, so increasing the expenses, and we are reducing the prepaid expense. So the prepaid insurance, to reduce it, it's an asset account. To reduce an asset account, if you remember, it's a credit entry. So we have on the debit side an increase and expense account, and we have on the right side a credit entry to decrease the asset, which is the prepaid insurance or the prepaid expense. Depreciation, it is the systematic and the rational allocation of the cost of a depreciable asset to expense over its estimated useful life. So when we're talking about an asset that will last for a long period of time, we have to use the depreciation expense for that specific asset over the whole useful life of the asset, which can be 2 years, 3 years, or 5 years. It depends on the asset that we are talking about. As a depreciable asset, it is used to produce revenue. The asset loses some of its utility and part of the asset is consumed until we get to the end of the useful life of that asset and we need to change it into a new one. At the end of the accounting period, the expense related to the consumption of a depreciable asset must be recorded as depreciation expense. Moving to the second one, where we are converting a liability to revenue. Here, looking at this adjusting entry, here is necessary when cash has been collected in advance for a certain revenue. An example is when a magazine publishing company collects cash for 2 years, for 3 years subscription in advance. They have collected the cash, but they did not deliver the product yet. So this cash is a revenue that they receive ahead of time. This requires an adjusting entry to convert this liability to a revenue. Another example is the airline tickets. When you buy an airline ticket ahead of time to book or to reserve a flight ahead of time, you will pay for the airline ticket, but you did not use the ticket yet. So the company will have this revenue as a liability because they did not provide you with the service yet. Again, season tickets for a sports team. You buy the season tickets ahead of time, probably 6 months ahead of time. At the end of the accounting period, an adjusting entry will have to be recorded to recognize the revenue earned during the period and to reduce the liability account, which is revenue collected ahead of time. The third one, the accruing of unpaid expenses. One of the key to understanding the accrual of expenses is to realize that an expense has been incurred in the current accounting period, but will not be paid until the following accounting period. So, one example is your purchase of gasoline from a station, from an oil service station, using a credit card. So you will be using that fuel, you are filling your car with the fuel, but you will not pay for that expense until for next month or for 2 months ahead of time. So you have incurred the expense, but you have not recorded the cost. You did not pay for it yet. So you probably will not record this expense until the following period. You're closing now, but you have some expenses incurred during that period, but you did not pay for it yet. Companies, they cannot follow this practice because expenses would be recorded in the wrong accounting period. So you have spent it today, you have to do the adjusting entry to do the expenses, to record the expenses in this period, not in the following period. This will violate the matching principle of accounting. The matching principle of accounting states that if you have cost to be that is used during that period of accounting, you have to register it into that specific period of accounting. You do not leave it to the second period. Companies, they are required to debit or increase an expense account and credit or increase a liability account. So for them, they have to put that they have used up these expenses, so they have to increase the expense. You have to debit an expense account. On the other side, you have money due. You have to pay for this expense. So it will be on the liability side, such as accounts payable, for example, or fuel cost payables. Almost all expense accruals will require this type of entry. Some common accrued expenses include interest owed on loans. So you are using the money, but you do not pay the interest on the loan yet. Some wages and salaries owed to employees. Your employees work for their salary, but you did not pay their salary yet. And property taxes that is owed to the local taxing authority. That can be paid every 3 months or at the end of the year. You have to take it into consideration. The fourth one is the accruing of uncollected revenue. This one, the revenue accrual is necessary when revenue has been earned in the current accounting period, but the cash will not be collected until the next period. Such example of revenue accrual will include interest earned. When we talk about interest earned on investments, for example, or on loans that are made to others, or you have provided a service, or you have work, you have a project that you have completed, but you did not bill the customer yet. So the revenue is yours. You earned that revenue, but you did not bill the customer to pay it for you. So this is uncollected revenue. In the adjusting entry, we just have to record a receivable. So you have rendered the service and you have to receive for it. So it's an account receivable. Account receivable is on the asset side. On the asset side, an increase in the asset side, it's a debit. And on the credit side, it is the uncollected revenue. So an adjusting trial balance is prepared after finishing all these adjusting entries. The same format will be followed as the normal trial balance.